Great. And we got Sarah Nolet here from Tenacious Ventures, a VC fund in the climate space. Sarah is American, but actually where in Australia are you?
I'm in Sydney.
Sydney. Okay. Yeah. And I had explored her fund a while back, and she's going to tell us a little bit about it.
Yeah, awesome. Well, thanks so much for having me and looking forward to speaking with you all. I will just share my screen, hopefully seamlessly. How did that work?
Coming up. Looks good.
Awesome. Cool. Well, I thought I would start. I'll mostly just give a brief overview of kind of who we are and what I think is different about us. But what I hope it provokes is for you guys to think about how our food system is changing and some of the opportunities for different kinds of interventions as we think about the unique role that agriculture and food plays, both kind of being at risk to climate change and having a role in reducing emissions as we think about transition. But I'll start with a little bit of a story. And this story zooms us back about 6 years now to a large conference that happened here in Australia on an island in the Sydney Harbour, where a bank flew in a bunch of farmers, a couple hundred farmers, to a conference that included a pitch competition. This was kind of a traditional startup pitch competition. There had been a long list of companies. It was selected down to a short list, and 5 companies were pitching to this audience. And I was fortunate to be selected on the judging panel with a few other folks, actually, I think a few other all gentlemen folks on the panel. And we watched these pitches. And what happened was all of the judges, except me and one other, picked one company that should be the winner. This company looked and sounded a lot like a lot of the traditional tech startups that you might hear from. You know, they had kind of tech t-shirts, jeans, young, really polished, pitching a software-based business model. That's who the judges picked. The other gentleman, Matthew, and I picked a different business, one called GoTerra that you see here. We were the only two, so we were outvoted and we ended up losing. But if you fast forward, what has ended up happening 6 years later is that first business no longer exists, and those two co-founders ended up in jobs in the consulting and investment banking world. But this business, GoTerra, has done really well and actually became one of our first investments. And what we really liked about it was a couple of things. One, it was a pretty unpolished founder, but she really knew how the system she was operating in worked, from what were the economics, what were the power dynamics, and what technologies would really actually work for the users. It was hardware, not software, but she really understood the technology. And we just realized that if we're going to solve big problems in the future of food and agriculture, we have to look beyond a traditional Silicon Valley style pattern matching. We have to look at founders who come from different backgrounds. Her background's in wool classing and horse trading, and not the tech side of things. And we have to look at otherwise kind of dirty, gross, tough industries like waste management, where this technology operates. So GoTerra's raised now just over $10 million. They're operating across Australia, being rolled out by national retailers to do on-site organic waste management with their modular units, inside of which is an insect. So in other words, you could call these maggot robots that go on site. Here you see it in a parking garage, which sits below a hotel, restaurants, and office buildings to manage all of the organic waste that comes out of it. And I love this example just because it showed a little bit of how me and that other gentleman, who ended up becoming my business partner and co-founder in the fund, realized we saw the world in a pretty unique way, and realized that we wanted to deploy and really unlock capital for these businesses that maybe didn't look like others, but were solving big challenges in food and ag. So that's how we started Tenacious, and realized that we really need a food and ag specific venture firm, because taking these generalist VC approaches is going to leave value on the table. And so we invest at the intersection of food and agriculture and the massive transition that it's undergoing as we think about the need for new climate solutions in the coming decades. And there's a few things that are different about us, which basically I highlighted before. One is that we are pretty thesis driven. So again, rather than sort of look at what other VCs are investing in, or even just what comes in the top of the funnel, we do a lot of our own thesis development work. So we actually do primary research on how the food and ag system is changing in partnership with some of our investors who are farmers and agribusiness corporates, as well as companies that operate in Australia and internationally, and make sure we really understand how the system works. It's kind of the first one. The second one is that we embrace what we call deep tech, or I think in the US is more commonly called hard tech, but really this idea that you can't eat software, unfortunately. And so as we think about decarbonizing the food system and building the food system of the future, we are going to have to transform atoms and molecules, not just bits and bytes. And that takes a little bit of a different approach to investing and sourcing and supporting these companies. And finally, for us, there's a lot of focus around impact these days, and climate impact. Some of it's window dressing, some of it's well-intentioned. For us in food and ag, it's really where we think the differentiator comes from, because food and agriculture is under so much pressure to not only do better, as in reduce emissions and contribute less to our international greenhouse gas footprints, but also to be part of the solution, to bring things like sequestration of carbon, to have more natural capital based solutions, to have jobs and food security and healthy food and nutrition. And really, it's this unique do good, do well opportunity that we think food and ag is uniquely well placed to do. And looking through that lens helps us identify founders that are really going to dig deep for what is a long haul to solve some of these problems. So here's some of our Fund One companies. There's actually a few more that we've invested in now or that have become clear, but truly it's everything from green ammonia, novel ways of producing fertilizer, into on-farm robotics, biological pest control. We've got packaging companies, we've got waste management companies, we've got carbon and natural capital companies. We've got companies that produce food in new ways in labs or with plants instead of meat, and companies unlocking new forms of finance to enable the transition to the future food system. And they break down into the different 6 themes that you see there at the bottom along the lines of that thesis development that we do. So that's really it for us. We happy to talk more, probably not about us, because it's more interesting to talk about the future of food and ag and how it's changing. But just wanted to share the kind of origin story of where we come from, how we think about the world and what's different, and hopefully have a conversation about the intersection of agri-food innovation and climate.
Great, Sarah. So what do you see like as some of the tailwinds in the food and ag industry specifically?
Yeah, so I would say there's quite a few. I mean, one tailwind for sure is the entrance of new capital that's thinking about climate. And that's kind of from an innovation perspective. People are looking at agriculture and food as an industry that can deliver technology that has decarbonization benefits. So we're seeing that as absolutely a tailwind and partners for us to co-invest with and more capital for these companies. I guess at the same time, I don't know if you call this a tail or headwind. I think it ends up being a tailwind. These international corporates in the value chain, whether you're a processing company or a CPG company or a retailer, are under increasing pressure to set climate targets and to do so in science-based ways that then require them to tackle the emissions in their supply chain. As you start looking at tackling emissions in your supply chain, there's absolutely a need for new technologies and new types of business models and new innovations. If you're a milk company and you need to think about the methane emissions on the dairy farms that you buy from, we don't really have good solutions right now. And so there's absolutely a need to think about how we invest in and build new ones, for example. So that's another. And then, we do have a growing population with changing dynamics that creates opportunities, whether that's urbanization or sustainability preferences or markets increasing demand like China. There's a lot of demand side characteristics that are creating new opportunities.
Got it. So what sort of companies do you see maybe most being disrupted, like that maybe publicly traded companies and sectors, that are going to get usurped by, startups and disruptors? and
Yeah.
maybe legislation even, right? Or requirements, that investors are placing or consumers are placing.
Yeah, it's interesting, right? I mean, our probably somewhat contrarian for venture capital thesis is we're going to see a lot of acquisitions. We're going to see a lot of companies fighting and needing technologies to make the transition themselves. And in food and ag, I'll give you an example. We think about alternative protein. Are we going to make dairy or meat with plants or with precision fermentation or cultured meat? Definitely some percent of the market will go that way. But some large percent probably won't. And if you're, depending on where you sit in the supply chain, you've got existing CapEx investments that are going to make a lot of sense to leverage to bring these new types of products into your portfolio. And that probably creates more of an acquisition or diversification opportunity than necessarily a disruption opportunity. So I think there's a lot of that kind of dynamics. One area, though, where we do see a lot of potential for disruption is around autonomy. If you think about just making tractors and equipment on farms be able to be used without a human, nothing really changes in the system. You're still going to sell it through the same channels. You're still going to service it in the same ways, but nothing really changes. But if you go to a fully kind of digitally native way of operating, you're in the field with a robot at very different times, and you have a very different amount of data about what's going to be grown and what's going to happen before it even happens. So when you know what kind of fruit is coming off the tree and at what quality, or where the weeds are before they even emerge, do you need to spray chemicals, or can you go along and zap the seed bank with a microwave or chip away at it with mechanical weeding? And do you need cold chain storage when you can have a just-in-time supply chain, because data tells you when stuff is going to be harvested before it's even ready? So that kind of mid-infrastructure around cold chain doesn't really make a lot of sense anymore. So I think that's probably the biggest area where we see disruption coming as we transition to autonomy at the farm level. Some of the chemical input companies and some of the kind of mid-supply chain processing companies are going to be under a lot of pressure to change their operations.
Got it. So going like maybe circling around a little bit to your fund, what are you showed some of the other companies, big winners there. I'm going to ask a couple questions in a row, and then you can jump in and get the ones you want and avoid the other ones. How many years has the fund been going? So you met your partner Matthew, right? 6 years ago.
Yeah,
And
2016. So I guess coming up on 7 now.
almost 7. Cool. And so what's your minimum? How many years are you currently raising for a fund? And then I had already asked about the other winners.
Cool. So I'll go in reverse order. So I previously ran an advisory business doing work in this space. And that's actually when I met Matthew, when I was judging that pitch competition, and how I realized that what I was really sitting on was, deal flow, an investment thesis, and a space that was really ripe for disruption. And so rather than being in the advisory consulting game, it was time to raise a fund. That was in 2019. And so we did first close of Fund 1 in 2020. So initial investment started in March 2020. We didn't do final close of that fund until March 2021. So the average vintage for Fund 1 is somewhere around kind of 2 years. That fund has 12 companies in the portfolio, and we'll expand it to probably 15 or 16 over the rest of this year, which means we are just starting to raise a second fund, and we will basically go again and build a portfolio of kind of 20, 25 companies based on really the same model. And so investors that come into that fund are anywhere from kind of a couple $100K commitment that gets drawn down over a couple of years up to many millions, depending on the flavor and type of investor, which is the same as we have for Fund 1. And in terms of breakout successes, I would say GoTerra that I highlighted. I mean, they're gobbling up market share in the waste management space in Australia. And it's really going to be a big year for them as, the tech's built, it's proven, it's working. They've got happy customers that are now signing up for multi-year take or pay, multi-100,000, multi-million-dollar contracts. And so we're really excited about their progress. The other one would be Swarm Farm. They're an autonomous agricultural, robotics company. They build robots that do various tasks on farms. You might have seen some press about this space more broadly, and companies from Google or Alphabet to John Deere and Case New Holland doing stuff in this space. What we really like about Swarm Farm is the tech truly works and is commercial. They're on over 1 million acres already, solving problems like significantly reducing the amount of chemicals that producers use when they manage their weeds, up to 98% reduction by being able to go along and selectively spray autonomously 24/7 without compacting the soil nearly as much. So those are two that are significantly commercial, and we're starting to see the kind of revenue and performance and things really tick up.
Okay. And did you want to address like the minimum? Did you say that? Was I
Yeah,
was
I mean,
doing a
sort of
little,
couple hundred. Yeah, yeah. I answered 7 questions rapid fire. I definitely can work on talking slower, as the previous speaker highlighted. So appreciate that. Yeah, couple hundred K, technically 250 Aussie, so about 200 US.
got it, got it. Okay. And like so I actually have 2 questions, but when people are looking at funds, VC funds, what do you think, in your opinion, not necessarily your fund specifically, but other funds, what should they be looking at? And then my other question, and you can either do these separate or combine them, is are you aware of like opportunities that maybe people can get into this space at lower ticket prices?
Yeah, yeah, definitely. So, in terms of VC funds generally, and obviously I can't give investment advice, and this is not investment
Sure,
advice,
yeah, all the, yeah.
all the caveats. So, venture capital is very much just one tool in the innovation toolkit, and the benefits are, it's high risk, potentially high return investing. If you're otherwise interested in startups, otherwise see kind of high risk early stage innovation as important to your goals, which might be around impact or returns or some combination, the benefit of a fund is that portfolio approach and managers that are spending 100% of their time sourcing, filtering, and supporting opportunities, versus maybe angel investing where you're kind of picking for yourself. And so you might be entirely qualified to do that and to spend time doing it, and you might see and access the best opportunities. But again, if you want to partner with a fund, you're getting that exposure to the whole portfolio and the kind of benefit of their engine for sourcing and selecting and supporting companies. And then different funds have different theses, how early they go, how late they go, how big their teams are, how big their fund is, how big their checks are. And that gets into sort of individual, portfolio construction kind of thinking. But I would say that's part of the reason. For one other thing I would say is the transition, like decarbonization, is going to require something like 9 trillion a year of investment, I think is what McKinsey highlighted. And a lot of that's going to come into new technologies. And so, who's going to build them and who's going to back them. And so for us, and for me personally, as a leverage point for change, I spent a lot of time thinking about, should I go work for a big company and move the big ship a small ways, and ended up saying, transformative new innovation is needed, and new ways to unlock capital to back it is needed. So I think that kind of overall thesis is important as well. In terms of how to get involved for smaller, different ticket sizes, it really depends. If there's plenty of ways to support companies directly, to make intros, to amplify their mission so that they can get their word out there, to angel invest or look at a syndicate, maybe a fund that you can come in per deal rather than have to invest in the whole fund. There's Slack communities around climate and agriculture investments. There's newsletters. So if anyone's interested in getting into this space, super happy to provide resources or connect dots where I can. Ultimately, we need both more capital, but definitely more smart people paying attention and working in food and ag would be my view. So if there's ways I can make that happen, I'm super happy to.
Cool. So I'm going to add a little bit of insight here and then maybe turn it into a question. But like I've read, studies like in terms of diversification, and I don't think you were here when I was talking about my blackjack background as a professional blackjack player, but appropriately sizing your bets relative to your bankroll and in the investing world relative to your portfolio size. So, with big publicly traded companies, you might get a decent diversification with 20 to 50 stocks, say, right? There's some diversification benefits beyond 50, but it starts to go down a little bit, right? Where I've read in the VC world, the startup world, some studies have shown that it's as many as 500 to get like sort of proper diversification, because the tendency is to have some losers and then a big winner. And it's that big winner that really launches your returns. And if you don't have a good exposure, there's a chance you don't have that big winner, basically. So I think there's a question in there, or at least your thoughts on it a little bit.
Yeah, absolutely. I mean, the traditional venture capital power law theory and the data of VC over the past 20 years absolutely backs that the conventional model that has been most successful, not the only model that's been successful, but the conventional model that's been most successful is based on a large enough portfolio for diversification and then ability to follow on into the winners, because by far it's likely that one company delivers the whole return for the fund, and that you do have a lot of ones that don't perform. Our view and why we're quite different in terms of having a smaller portfolio and being sector specific is based on the idea that in food and ag, with this climate transition, we need a different type of company that's probably going to be more based on deep tech, as in it's going to be non-software, and these companies are going to get acquired. So our strategy is more around owning more of the company, funding the de-risking of the technology in the early stages, that then allows them to scale up or get bought early, often without additional dilution, because they're using debt or project finance to scale up, and they're getting acquired. And so we are targeting a little bit of a different style of venture intervention by being sector specific and thinking about deep tech. So yeah, there are different models in the space. Absolutely, the one you outlined is the conventional one, and it's not the one that we think will work in food and ag.
Got it. So I want to touch on something that you brought up. And I had listed this in my notes as sort of form over substance. This was a note to myself before hearing you speak. And I think you sort of alluded to that a little bit at that pitch contest that you and your partner, Matthew, went with someone that wasn't as polished, maybe didn't have, the form and, the exterior look. But you looked sort of beyond the cover of the book and got into the details. So what can investors do to sort of take that mindset? Because I actually think that's important. I think a lot of times people make mistakes making decisions on the exterior form and not really looking at the nuts and the bolts of things. And so what can you sort of say to investors that maybe get them to look more at the substance and less at the form?
Yeah.
And you know what, before you get in there, I will say that form, because it's sort of the rules, it shows your ability to execute on what's expected, I guess. So I'm not completely discounting form.
Absolutely.
Anyways, go on.
No, I mean, I run the risk of rambling here because it's a topic that I mean, there's no one answer to it. If I could solve it, I absolutely would. My frustration with venture capital for sure is there's a lot of hype based investing, and there's a lot of pattern matching. And so when you are looking to pick a hot category and the best company in that category, what does best mean? Well, it's their ability to generate more momentum and interest and FOMO from other investors. And that often comes more from the sizzle than the sausage, to give another metaphor. And so it's absolutely frustrating. I think the reality is, in the early stages, it's really hard to tell because sometimes there isn't a lot there yet in terms of substance. And so knowing what you're actually looking for in terms of substance is important, because if you need to wait till the technology is proven and the demand is there, you're not an early stage investor. It's just not going to exist at those early stages. And so for us, a couple of things we think about is, yes, is there a pathway to build the technology? But we've seen lots of examples of really good tech that doesn't actually get adopted. It might actually be better than the competitive technology, but it doesn't get adopted. So what's that kind of business model that's going to get it in the hands of the customers? And there might not be a fully baked business model, but what are the signs that that's going to exist? So it's just an example of, you can say the form versus the substance, but having a view on what kind of substance you need. Do you need a fully proved technology? Do you need a fully proved business model? Do you need something around the team and their background and track record? That actually gives you the focus to then go deeper and suss out through diligence the substance in any one area, knowing that, again, it might not all be there at the early stages.
Got it. Got it. Okay, Sarah, thank you so much. That's Sarah Nolet from, do you pronounce the T? My wife is French, so I sometimes drop it.
You do pronounce the T. You can imagine it as ETTE, like it's a hard T, Nolet.
Nolet, sorry about that.
No
I did
worries.
know that, but I think it's been since last year that we really talked. And
All good, Matt.
I do want to give another look at your fund because I like your approach, and I think you're